Good afternoon, YouTube. Today I'm going to be talking about the CPI data and what it means for the economy, and if the Federal Reserve next week should be cutting interest rates, keeping the same, or hiking, which certainly they should not be hiking. That's a hint of where my head's at right now. But that being said, I'm trying to build a community here, so please hit the like button, hit the subscribe button, as well as leave a comment down below. I want to start doing early morning live streams, and growing that community is the first step to doing that because I would love to eventually be able to talk about the CPI data on its releases in the morning, as well as maybe even doing market close live streams. So if that's something you'd be interested in the future, please hit that subscribe button and become part of the community so we can continue making it a step closer to being there. With that being said, let's just get right into it. First off, I'm just going to go over the CPI data results. For those who may not have seen it yet, maybe you have, but I'm going to talk about the data that we got, and pretty much later on I'm going to go into what it means and why the Fed should be doing what I think it should be doing. For headline CPI, we got plus 0.1% month over month. That is down from plus 0.2% in April. And year over year, we're at 2.4%, barely up from the 2.3% we saw in April, which is still close to the Fed's 2% target, which some analysts actually argue that the idea of reaching a 2% target isn't actually accurate, and some believe it should be more like mid 2%. So from that argument, inflation could be perfectly stable for growth aspects of the economy. I currently like the rate that it sits at in the 2.4 to 2.3. I think 2%. I don't know. I feel like that should be like the minimum of where you want it. Like I feel like that's a good rate for it to be at, but once you start playing with around with the idea of you could see 1.9% and still call it like how is 1.9% worse than 2.1%? I'd prefer the 2.1, and that's just the idea of growing economy because then I know the businesses are doing well per se. But that said, that we got core CPI, that is food and energy, and that was only up 0.1% month over month and plus 2.8% year over year, a slight decline from previous months and a sign that underlying inflation is cooling. This suggests that tariffs have not yet created upward pressure on consumer prices in May. First off, I want to talk about energy costs. We all know Donald Trump loves drilling. Like, that's his thing. Drill, baby, drill. And gasoline prices fell 2.6% in May, and that's going to be a continued trend. Like, he just got in office. We are going to be drilling more, and more pipelines are going to be created. And that's just how he envisions America. He envisions America getting their own energy, no longer getting it through trade. And I think that is big for this country. From an economic standpoint, that's huge. From a global warming standpoint, you guys might argue otherwise, but the way I view it is no matter what, we're going to get that energy, and no matter what, someone's drilling it. So whether we do it or Russia does it, it doesn't make a difference. So we might as well do it for ourselves, especially if it's going to save us money. The energy index is down 3.5% year over year. These declines offset food and shelter inflation, further easing pressure on households. This helps anchor short-term inflation expectations, giving the Fed more room to cut. That should be a hint of where my head's at. I do believe we need to be cutting right now. I think inflation's coming down, and I'm going to keep going because I don't want to spoil what I got going on further. The labor market softening. There's no denying the labor market softening. You got U.S. unemployment rate still sitting at 4.2%. Job creation is slowing. All the data points we've gotten as far as like job creation has all been pointing towards job creation slowing, as well as I'm actually a recent college graduate. This last spring, you could have asked anybody in my classes. Like, we would have speakers come in, and I go to a Big Ten school, so it's not like I go to a small college. I go to a Big Ten school. It's very well known, big name. And we'd have a speaker come in, and they'd ask about like a 100-person class, how many of you guys have a job lined up after this semester? And we're all graduating. And you'd see probably 1/10 of the room. College graduates cannot find jobs. A lot of the employers expect us to have like real work experience going into the job. Like, they expect us to not need training whatsoever, whether it's working with like a database or coding. I was an advertising management major, but I've had someone ask me already, like, could you code this website for me? I'm like, yeah, with training, but nobody wants to spend time training because the other thing that goes into it is they they're being very harsh on who they are hiring. One, because the job market's tightening due to where the economy stands, but two, AI is taking these white collar jobs, and that's been said by these CEOs multiple times. Like, there's no hiding it. AI is a real player for taking these jobs, and it's making the entrance into the field way harder because it's so close to getting to the point where AI can do most jobs. So these entry level jobs that most college students would have took in the past, they're not available anymore because AI can easily do it. And why pay someone to do it if it can get done for free? So job market is softening. That's for sure. And tariffs are yet to cause inflation. One of the biggest bear arguments was that Trump's tariffs will cause inflation. We'll see it reignite, and therefore rates need to stay higher. And May was the first full month under Trump's new tariffs, yet inflation remained muted. This suggests either the tariffs haven't fully passed through, or companies could be taking it in their margins, which like Donald Trump called on Walmart to do, but yet we saw inflation increase on food, and the consumer could be growing more scarce, which is also, I've been seeing reports and data saying that the consumer has been saving more, and that could be because of this current stance of the economy and feeling like, maybe a recession is on the verge. A lot of the tariff talk took over the news, and a lot of news is meant to scare people. So anyone who's watching the news, like my mom, for instance, she doesn't really keep up with this stuff, but even she knew about the Trump tariffs. So it's something that everybody was aware of, whether you are an investor or not. So it could have got people more scarce and tightened their money, and that also made demand less, and that could also be a leading factor to the disinflation we've been seeing, and that's a big argument I've kind of seen from the start. So I think that's a big reason inflation cooled as fast as it did under Trump, but I also still don't see inflation reigniting as we are nearing these trade deals. We just pretty much came to terms with one on China that's supposed to be full details releasing soon, but we just need another Donald Trump and Xi phone call, and everything should be set on that. So as these trade deals continue to come along, as long as they don't take longer than expected, uh, inflation should continue to stay where it's at. So cutting in June allows the Fed to get ahead of potential economic drag from prolonged trade tensions without stoking inflation. And then we have services inflation that's losing steam. Medical care was up 0.3%. That's down from the plus 0.5% we saw. And shelters plus 0.3%. Still sticky, but it's not accelerating. And there's been a lot of data showing a lot of house cuts um, happening. And so I honestly think that once we get June data, we could actually see shelter declining from where it's currently at. And so airfares of used cars and apparel all declined. The disinflation is non-core and discretionary categories further support the case for easing. So my conclusion is inflation remains under control despite new tariffs. The labor market is weakening and energy prices are falling. With trade deals underway and signs of cooling across key components, a June rate cut is justified to one, prevent over tightening, which I think should be the fear, because if we over tighten, the job market goes into shambles. Yes, you finally fix inflation, but the other issue is the country's deficit on debt is gonna go tremendously up for no reason. We are going to be refinancing our debt on super high rates, when if we could have just took the risk on cutting like I believe we should be now. Not only do I think it's a hedge against having to refinance debt at such a high rate, I do think it's the right decision, but when you weigh it all, you can over tighten, refinance debt higher and let the unemployment go into shambles, or you can cut once, then you're refinancing the debt at least at a lower rate, potentially even lower rates than this one cut, but you're refinancing at a lower rate. Uh, you save the unemployment market, and there is a chance that inflation starts to tick up. Like, I feel very confident that inflation will not get out of control because of our one rate cut while we wait for more data. I don't think it's an issue if we get one more rate cut and then continue let data come in for the next 2 months and just observe from there. Because if it stays flat, we can keep rate cuts where it's at. If it starts going down some more, we're already super close to 2%. So there's no reason in my mind you couldn't, look to lower again in the next 2 months if that's the case. And if it starts ticking up, that one rate cut is not going to be the reason why inflation went berserk up. And if it goes berserk up, I think we had a bigger issue than we had in the beginning anyways. Um, so that's another reason I do believe that one rate cut is the right decision. It supports consumer spending, offset tariff drag, and preempts potential recession risks. I want to say, though, before I end this video, none of this is financial advice. This is just my stance on where I think the Fed should be going, and they do not look like they want to cut whatsoever. But I do feel like if we don't cut this time, yeah, maybe the economy still makes it through. But I actually believe, like, I don't think we can go many more months without a rate cut. Maybe we can go one more Fed meeting without one, but I think it's cutting it super close. But this is not financial advice, like I said. It's just where I believe the Fed should be going. So, that being said, my social media, on Twitter, it's at investing_intel. Go drop me a follow. I drop all my live thoughts there, as well as, like I said in the beginning of the video, please comment, like, and subscribe. I'm trying to build a community here so that I can start doing some live streams and give my own genuine thoughts as I process new information that comes in, and continue to look over new companies with you guys, because it's honestly one of my favorite things to do, is just go over new companies, see how they are trying to help the growth in America, and just do a deep dive and evaluate them. It's yeah, I don't know what it is. It's just I have fun doing it, I guess. So that being said, thank you guys for your support, and I'll see you guys in the next video.